Good afternoon, good morning, good evening, depending on where you're coming from. Welcome to another lecture about swing points. A lot of traders, a lot of people out there do call things swing high, swing lows, and they mistake, and this is why they usually end up losing because they learned them wrongly. So I'm going to be focusing about swing points, for example, swing high and swing lows, because these are very, very important. For example, if somebody comes and tell you that, let me give you a very good example that this one right here is a swing high. Some of you might mark this one as a swing high, this one right here, which is completely wrong. So they'll be waiting for, maybe liquidity and also I'm going to be talking about liquidity sweep and liquidity grab, right? And market structure shift. All these have the same thing in common. So for example, I'm going to go straight to the point. What is a swing low? What is a swing high? And as I've said it before, most of you don't even know what a swing low is or swing high is. You just mark them and you think that's it. The swing lows and swing highs plays a very major role in trading because they are where liquidity is stored. These are the levels whereby stop losses are put. A stop loss is liquidity, that is money resting there. Literally, it is money. And I'm just so dedicated in helping people out there, helping people who don't know how to do these things correctly. I'm not asking for anything in return. I'm not asking for any money. I'm not asking anybody to join my mentorship and so on. If this can help you, learn and walk away. Go and just do your stuff. So that being said, what's a swing low? I'm going to begin by swing low. A swing low is a situation whereby a candle has failed. A candle took liquidity of a previous candle, and the next candle failed to take its liquidity. Its liquidity simply means that if we are bearish, I'm expecting we continue creating lower lows. For example, this is low compared to this one. So this is a lower low. These are low, but these are lower low. The same thing over here. This is now a low. I was expecting this one to be taken out so that this one, we can continue going lower. But when the moment price fails to take out this low, or the next candle fails to take out this low, we ended up creating a swing low. Swing low is made up of three candles. I want you to note this carefully. It must have three candles. So the first candle is the one which is going to be swept. For example, this one swept it, right? Then the next candle should not be swept. It should remain creating that pattern, that swing low pattern. I'm going to repeat again. A swing low must have three candles. The first candle should be swept. Its low should be swept like this one here. But the candle that sweeps its low should not be touched by the next candle that is following, the third candle. So this is the first one, second one, and third one. Now we have a valid swing low here. Once you see this simply means that some people have bought somewhere here or anywhere and they've put their stop loss right here and they don't understand the concept of liquidity. So what happens? What happens is very simple. They're going to be stopped out, that you see here, with the smart money. Then once they've been stopped out, smart money waits for something like a market structure shift. Market structure shift also has a very, very important relationship with this one here. So they wait until they see that market structure shift, because without the market structure shift, then it's all liquidity grab. For example, market structure shift also must happen either on a swing low or a swing high. You see people marking, market structure shift. You see people marking swing low, swing high, but they don't really tell you this. This is how like me. It took me long to realize this, and I realized this by I don't know if I see, this is ICT concept, and I think maybe I was just in my zone. I really never paid attention to what I was talking about. That is how you map a swing low. Let me give you another good example. Here's another swing low. How is it a swing low, or why is it a swing low? Because we have our first candle. The next candle comes and sweep liquidity below it, but the third candle fails to take liquidity below it. So it is a three candle type of thing. The third one fails to take liquidity down there. This makes it what? A swing low, meaning that there are some people who have put their stop loss right here. So how do you know that price is not likely to come back here under this swing low? How do you know this? You have to wait for a market structure shift on the opposite side, on the opposing side. And also, this is backed by liquidity graph, meaning that we took liquidity over here. You see this one? We took liquidity there and we purged it, creating this new swing low. Meaning that now the smart traders are waiting for these traders to be taken out, so they're going to be putting their stop loss right here. But they're not just going to be putting their stop loss right here without knowing exactly whether this thing is going to go up. So what do they wait for? They look for a swing high, the opposing of swing low. This is a swing low. The opposite of a swing low is a swing high, which is right here. It's the same concept. So how do we map out a swing high? A swing high is a situation whereby we have a high. The market fails to take the high of the second candle, like the third candle fails to take the high of the second candle. So you have the first candle, the second candle comes in, then the third candle comes and closes back instead of closing above or sweeping this high. This makes it a swing high. The same concept down here. The only difference is that now we have switched to the opposite side. Now this often happens when we are starting to look for bullish structures. We pay attention to swing highs. But also they matter in case we want to sell. Of course, we want to see liquidity grabbed above that swing high if we are anticipating a selling on specific point of interest. I'm not really gonna go into deeper into other concepts or other conferences. I just want to show you guys. This is specifically to show you guys how to map out a swing high and a swing low properly. After this, we're gonna be talking about market structure shift, which I'm gonna do in another video. So swing high is a situation whereby the second candle took liquidity of the first candle. Remember, it must be three candles, always three candles. So we took the liquidity of the first candle, but the third candle was supposed to also take this high so that we know that we are going higher, but it fails to take it. So it's a swing failure pattern. This is not a swing high, valid one. These are valid. Let us map another one. This is another valid. We have another valid swing high right here. This one here. Here's our first candle, second candle, third candle. As much as the third candle never took liquidity of the second candle, that's a swing high. Mark it like that, and that is liquidity. That is liquidity. Like there's money resting there. There's some people put their stop losses right here. So you as a smart trader, you have to wait for the markets or the algorithm to come and stop them out. What runs this market is liquidity. Money is what runs this market. And what it's looking for all the time always is money. So where are those money, staged at? The algorithm will automatically create liquidity, create inefficiencies, just to trap traders, then come back in there, take them out, then now deliver. This is now you get this idea of market makers and smart money traders and so on. That is how market makers operate. They generate liquidity and they wait for price to come back and take out some people out there, especially if they don't understand what's going on. Let me give you guys another example. This is another swing high, this one here, a valid one. This candle, the second candle, the third candle never took the high of the second candle, making this a swing high, right? Now, in this scenario, I want to take a look here. Price was not creating higher highs, it was creating lower lows. And over here, it was more of consolidation, because see, this high is above this high. Okay, this high here, this swing high is above this swing high, right? We never went to it. But instead, price ended up creating another swing, higher lows, right? Higher lows. These are higher low because this low is higher than this one, and this high is lower than this one. I hope I'm not confusing you guys. This swing high here is lower than the swing high above it, so it is a lower high. This swing high here, it is a swing high because we are dealing with the highs, we're not dealing with the lows. This swing high here is lower as compared to this swing high, so it is a what? Higher lows. Sorry, yeah. No, lower highs. Oh my goodness, these terms are just crazy. But I hope you guys are getting my point, right? So what's the magic here? What happened here? Over the situation, we ended up taking some liquidity. Also, this was another valid swing high. You see it? The third candle never took liquidity above this, the second candle, but it ended up dropping. Now, when dropping, our drawn liquidity was this swing low here. Unfortunately, because this swing low is institutional buy, with this one took liquidity of this one, it swept its lows, but the next candle failed to take out its low. It's a valid swing low, meaning that there was a liquidity resting here. But now, when after taking liquidity over here, we were expecting price is likely to drop towards this area, but unfortunately, it failed to take out these ones. What does that tell you? The moment that this price failed to take out these lows, it failed to deliver, meaning that there's something else cooking. So we have to be ready to or prepared. Now let's mark out the next swing high. So the next swing high we have is this one. So this one took liquidity above this high. The next one fails to take liquidity above it, and this makes our point of interest. So we are really waiting to see, since you have failed to take liquidity below here, there's now the concept of time and price always come in, and you realize that this happened during New York session. I'm using UTC plus 3, so that might be a little bit different with whatever you're using, but I'm using UTC plus 3. And now this one marks the next chapter of this lecture. Now the next, I'm going to be talking about market structure shift. A lot of you use break of structure, change of character, all those things, but the only thing that you really need that is really, really going to change, like how you read the price is this one, market structure shift. Once you understand this, and I'm going to be talking about this in the next chapter, it's very important. Market structure shift. The point of this lecture is to help somebody who is struggling with swing points, somebody who's just randomly drawing stuff over there and thinking that now they know how to trade and so on, because definitely you're learning from the wrong person, and they've highly convinced you that whatever they're doing is correct, and you think that they're correct, and you end up losing money because they teach you incorrectly. It took me a lot of years, long for me to just, deeply study what's really going on here. So in the next, I'm going to tell you guys why we pushed price from this level, and where exactly were we headed to, and why even price pushed lower back again to take some swing lows here, liquidity here. Remember, I told you guys there's some people who put their stop losses right here. But now there's a reason why this market shifted from this area going down. There's a reason why this happened, and we're going to look at it on the higher time frames, and that also now concerns top-down analysis, whereby you have to pay close attention to higher time frames. So I'm going to go do that in the next video about market structure shift. So this is just a short one. I wanted to make it clear how to map out swing highs and swing lows. Again, for the last time, I'm going to do this for the last time. This is a swing high, this is a swing low. Why? Because this candle here took liquidity of the previous one, and the next one failed to take liquidity below it. That's a valid swing low. Meaning there's some people who have put their stop losses right here, but we have to take a look at this swing low here. Has it done any damage? Yep. Take a look. There were some people who put their stop loss right here. Liquidity, money. There was money resting here. They've been purged out. And the fact that we just sweep liquidity, meaning that candle only did the damage and went and closed back in, that shows that there's a possibility of this market wanting to reach for something liquidity higher. It's all about liquidity to liquidity. In other terms, you can call them swing point to swing point. When you put them all together, there's some other concepts such as the things like PD raise, for example, premium discount. For example, in this area, if we grade this dealing range, we're gonna end up in a discount level. Okay, I'm not gonna go into dealing ranges. I'm not gonna go into Fibonacci retracement. I'm not gonna go into, but I'm just trying to give you guys a whole concept that there are some other things that I'm not talking about right here. For example, this is a PD array. This is a fair value gap right here. Okay, this is a swing high, and apart from it, there's another gap down here. When you leave that behind, this is an order block. Where did price come back to? There is order block right there. There's a way you can grade this order block as well. Price came back to it exactly, and that's when we started having this push to the upside that we're having apparently. So I'm gonna come back in the market structure shift. So expect the next upload is gonna be about market structure shift. So I hope this helps, and if anybody has any question, reach me out. I'll see how I can be able to help. But I hope this was helpful in terms of you now being able to spot how to map out swing highs and swing lows properly, because these are what defines market structure. They are part of market structures, the swing highs and the swing lows. the swing failure patterns, like liquidity, where stop loss, they really matter. They matter a lot. I've really told you guys like why this is why we came back down here, because these swing highs and swing lows are where people put their stop losses. So, for example, there's somebody who saw like maybe we have a break of structure here, or change of character, or market structure shift, and they bought here, and for something like this, they went long, and let's say on this gap, so they waited price to come to this gap, then boom, they bought from that gap like that. They put their stop loss right here, and they were like, we're going high, we're going high. So, or maybe if they're trend line traders, let's say they drew a trend line right here. Let's say they drew something from here, something like that. Then they see a breakout, then they buy this, that. We go in up there at least, or we're going to take something up there. Well, they were right, but unfortunately, they never understood the concept of liquidity. You see, they were stopped right there before market going to deliver. You see, yeah. So this is what it's all about, and let's talk about market structure shift in the next one. And maybe for private, I'm a mentorship. I don't do that, but we could definitely discuss, or talk about something to see how we can be able to to help each other and so on. So I'm gonna go ahead and end this here.